Trading was hard until I realized that if I wanted consistent profits, well, I just need to take consistent trades. If you want consistent outputs, well, obviously you need consistent inputs. And it sounds so simple, but yet no one does it. And so I'm going to show you my exact 3-step strategy that I use to take the same trade at the same time every single day. And trading becomes so much easier when you just focus on doing one thing. I now have a 76% win rate and a 1.85 risk reward on average, and I'm already up around 600k on the year, and my mindset has completely shifted. My goal in trading isn't really to make money anymore. It's just to make every trade look the same. And here's what you probably get wrong. You think learning more, adding in more conferences, more concepts, more strategies will make you more profitable and make you more certain. But the only thing it does is lead to more confusion. And I used to do the exact same thing. But when I switched from trying to improve by adding more in to then doing the opposite, but instead switched to trying to focus on improvement through subtraction, everything changed. No more information overload, no more confusion, no more overwhelm. It was just a simple, repeatable process that I could profit from every single day. But the thing is, there is a prerequisite you need to do to make this work. At the moment, you probably don't even know if you're taking the same trade or what type of trade you're looking for. You can only do the same thing at the same time if you're tracking it, if you're aware of what you're actually doing. And that's why we need a journal. And so this is the journal that I use. You can see everything is extremely consistent. I only take reversals, low time frame reversals, always have my market structure alignment with the same sort of entry relativity. And I'm always trading around the same time, the second hour of Asia. And you can see consistent trades lead to consistent wins. But you can only have a chance of being consistently profitable if you're tracking what you're doing. Because how do you even know if you're doing the same thing? Your mind's going to lie to you. Don't trust your mind. Do you even remember what you ate last Wednesday? Probably not. That's why exactly like how we track our weights in the gym, we need to track our trades to make sure we're doing the same things and progressively overloading. So if you want my personal journal template that I use every single day, there's a link in the description where you can get it for free. It's my personal trading dashboard with all my conferences and my plan to help you get set up. And this hasn't just worked for me, it's worked for hundreds of other traders as well. And I guarantee you, this is the thing that you're missing. You need to be taking consistent trades. For another example, this is one of my students and he was struggling with consistent profitability. But as soon as he started implementing this journal and started taking consistent trades, we can see here, he started getting consistent results. He literally just looks for reversals around the same sort of time with the same sort of entry. Look at that. He has consistent wins. He literally got funded and got his first ever payout just by being consistent. And you don't need to have the most optimal or perfect setup. You just need to make it simple and easy to repeat. And so first off, the number one thing you need to get down is the timing. The market tends to do the same sort of things at the same sort of times. So anchoring yourself in time is extremely important. There isn't really a best time to trade, but the most important thing is that you trade at the same time consistently because you'll start to see the same sort of things happen. I found for me that the best time to trade gold was the second hour of Asia session. You can also trade the London session open. These are probably the best times for this setup. And so moving on, step one of this approach is just to identify a middle time frame range. I am only trading reversals. I do not trade any continuations. So the most important thing is that I'm trading it within a range because a reversal setup is all about playing a trade towards the mean of the previous move. So I need a ranging condition. If it's trending, I'm not trading. If gold is at all-time highs, I'm going to go outside and touch some grass. And so when I say a middle time frame range, I mean the past 4 to 5 hours of price action, it's been going sideways. And the thing is, there's multiple different types of ranges. And so the easiest way to identify a condition, identify a range, is just to look at how much it corrects the previous move. If you're correcting under 50% of the previous move and you're just pushing bullish, not much of a pullback at all, well, obviously you're in a trend. You're very directional. If you're pulling back to around 50% of this previous move, you're in a trending range. And then if you're pulling back or correcting over 50% of this previous move, obviously you're in a range, or I call it a ranging range. And so I have a couple different variations of the setup that I trade, adapting to these different conditions. Because the most important thing is to be able to adapt. You want to do the same thing every single day, but you still need to be adaptable and a bit flexible. So looking to trade the same setup, but very close variations of that setup. So for some examples of identifying a condition, you can see here, if we're correcting over 50% of this previous move, over 50%, we're in a range. If we then go into correcting under 50% or around 50%, we're moving into more of a trend or more of a trending range. And again, for another example, we have a normal range here where we're correcting over 50% of this previous move. We then switch into more of a trending range here. And as you can see, it's pretty much always in between a trending range and a range. It's very rare that it's actually trending. And this is why it's always better to trade reversals, not actual continuations, because most of the time it's going to be in some type of range. And so here we go. Here is a normal trend where we're just kind of pushing in one direction. Sometimes we correct 50%, but most of the time we're just pushing in one direction. It's extremely rare that you have this type of trend high volume condition. This is why I would recommend actually trading reversals in some type of range because they happen more often than not. And then so after you've identified your middle time frame range, step 2 is just wait for an hourly candle to overextend into either the high or low of that range. And so here we have a middle time frame range. Over the past 5 hours of price action, we've been correcting over 50% of this previous move here. And so we just want to wait for price to either keep continuing to overextend into the high of that range or overextend into the lower half of that range to look for a buy reversal. And in this example, we have the hourly candle open and we immediately overextend into the lower half of this range. And so how do we classify a middle time frame range and an overextension? A middle time frame range is the past 4 to 5 hours that we've been correcting over 50% of that previous move. And then an overextension is that you have at least 15 to 30 minutes of price action, 2 50-minute intervals, push in one direction. So as we can see here, over these 20 to 30 minutes, we've just been pushing high volume in one direction. So I'll classify that as an overextension. And then for step 3, we just want to wait for a type 2 shift around 30 minutes into the hour. And we'll go over what that means. So in this example here, we've overextended into the low of this previous range. And then we're approaching around 30 minutes into the hour, the second half of the hour. We just want to wait for a lower time frame to shift direction to be moving bullish. What a type 3 shift looks like, it's just a break of a low into a break of a high, a shift in highs and lows, a shift in direction. This is a bullish example. For a bearish example would be that we're making high highs and higher lows. We're going to break a high into immediately breaking a low into shifting bearish. So we just want to wait for a lower time frame to shift in our direction. So in this example here, we have a break to a low into a break to a high, a pullback, and then a correction of that. And so this is a pretty nice shift around the second half of the hour to correct the previous move, the overextension of the hourly candle into the lower half of this range. So pretty textbook range rejection. And then in the next hourly candle, we have it immediately open and push bullish for 20 to 30 minutes into the upper half of this range, which is really nice. Pushes into an hourly AOI. We classify an AOI through an open close of a candle. We can just draw a zone around it. And then we can just wait for a shift around that halfway point of the hour, where we go from breaking a high, which we have, into breaking a low, pulls back a bit, and then corrects that previous move. So this is by far the best sort of simple setup to take. You just wait for price to open, overextend into either the high or low of that range. Around the 30-minute mark of the hourly candle, you wait for a shift and then take this small little correction in the second half of the hourly candle, targeting, I tend to target around 50% of the previous move. So the bigger the move, the better the target. For stop loss, you're just doing the high that you broke or the low that you broke. So the high that you broke, and then we'll go into entry refinement a little bit later on in the trade examples. And this setup is extremely simple. It works really well, and you don't even need to care about direction. You're not trying to guess direction. We're just trying to play little reactions at the extremities of the range. You can see here another example. We have price open, immediately push bearish for the first 30 minutes into the lower half of this previous range. We have a shift to breaking a low into breaking a high to pushing bullish. And it's really simple, really easy. Just identifying a range, wait for an overextension, then a shift around 30 minutes on. And it's so simple. And so for our first trade example, we'll just zoom out and look at the overall condition here. As you can see, we're relatively rangy. We're correcting over 50% of this previous move. We kind of shifted into more of a bearish trending range. But if we go from the previous swing high to the previous swing low, we're coming into around 50% of that previous move. You can see here, we've also corrected around 50% of this previous move. So in a bit of a middle time frame bearish trending range. So overall, we want to wait for price to come into 50% or even a little bit above that. Wait to take a trade with the overall direction and the condition. If you want to be a bit more specific on where exactly you want to enter, we can use some high time frame areas of interest or levels. I just look at the opens and closes of the 30-minute, hourly, or 4-hour. We have an open close here, open close there. So a general sort of level that where we can have price react to within this general sort of range. So we have the new hourly candle open here. New hourly candle opens and we immediately push bullish. We overextend bullish for the first 20 to 30 minutes of that time. So I'll just get up my timing indicator so we can see here. So this is the first 15 minutes. This is the second 15 minutes. So 15 to 30 minutes into the hour, we've been pushing bullish, overextending. Really nice. And so now we just want to wait for a shift around this, sort of 30-minute AOI around the halfway point of the hourly candle. So we've identified our range. We've waited for price to overextend into the upper half of this previous range. It's a bearish trending range. We waited for the hourly candle to overextend into that upper half of the previous range. And then now we're waiting for a shift around 30 minutes on, and we'll go into a bit more details exactly how to refine our entries on those shifts. So around 30 minutes on, we have a nice type 3 shift. We have a pretty clear break to a high into a break to a low. So what we can do here is still use the 50% fib tool, and I'll go from the swing high into the swing low. And we're just waiting for price to come into 50% of this previous move to take our entry. So it's really nice. We want to wait for the 30-minute hourly candle as well to create that top wick here. And we're going to be looking to take our entry when we have some sort of reaction within at this 50% area, stop loss is going to be above that high. And then for our target, I always target 50% of the previous bullish move. It is, if it's like a really high volume overextension, you don't really have much of a pullback, I'll go the whole move. If we pulled back a little bit, prior to this, maybe I'll go from here, but really nice overextension. So target's going to be 50% of that. So around a 2 to 3 risk to reward. Okay, so now that we've come into the 50% of this previous bearish move of the type 2 shift, bit of a nice reaction there, bit of a bearish sort of impulse. So I can just take an entry with the stop behind previous high, and I can target that 50% area. And so these trades tend to play it pretty nice. You had that textbook, didn't find the range, wait for price to overextend. And then you had that shift around 30 minutes in, you've targeted 50% of this previous move. And yeah, it'll sometimes go a bit further, but this is the most consistent, easiest way to take profit there. And you still get a pretty decent risk to reward. So this was a trending range example. We'll then go over a ranging range, or just a normal range example. You can also kind of take this as a counter trend. So you can do a counter trending range. And this is actually a trade I took last week in the Discord. This was the second hour of Asia. So we had a stop below the recent low. We then went into breaking the recent high. And so this was an example of a pro trending range reversal. Then we have now an example of a counter trending range reversal. Here we've had the hourly candle open, not much of an overextension, but we've been pushing bearish. And this was actually a trade I took last week where we had a nice overextension. We broke a low around that 30-minute mark into breaking a high. What this would look like on the second chart, which is what I tend to drop down into to refine my entries, well, we have a clear break of a low into a clear break of a high, overall high time frame sort of range. If you're trading counter direction, ideally you always want to wait for price to break against you. So if I'm taking a buy and it's a bearish trending range, ideally I always want to wait for it to break the low to then look for the reversal. Ideally, I'd want more often than not, I'd want more of an overextension, but this was a really nice shift. Pretty clear, simple trending range as well, and it had nice correlation on the setup. So pullback was on the 5 seconds chart. I was waiting for a bit of a reaction here. So as we can see, come into 50%, and then we have a bit of a 5 seconds reaction. So a bit of like a shift within the shift. We break a low into breaking a high. So we can just take our entry here. We can put our stop below the previous low here, and I can target, if I get the 1 minute chart, I can target 50% of this trending range here. So our target would be around there for a 1.9 hour risk reward trade. And as you can see, plays out pretty nicely. Oh, pulls back a bit, then taps me out. Pulls back a bit, then taps me out, and it plays out pretty nicely. So you're just identifying the range, waiting for price to overextend into the upper or lower half of that range. If it's counter trend, ideally you want it to break against you. If it's pro trend, it can be around 50%. We'll go into more of a ranging example in the next trade as well. And so in this sort of setup, direction doesn't really matter. We're just trading small reactions in price action. It matters more where you are and when you are within the trending range or within the range. And then so for this example, we are in a bit more of a range. Over the past couple of hours, we've just kind of been moving sideways, and we can identify the high and low of that range. And so we have a new hourly candle opening. And so let's see if we overextend in a certain direction. We overextend into the bottom half of this previous move here. So pretty nice overextension. We have an hourly candle pushing bearish, coming into around the previous open close level of that sort of move. And we're around 30 minutes into the hour. We've broken a low into breaking or potentially breaking a high here. So we can just wait for that break of the high. And then see, it corrects towards 50% of that previous move. In this example here, unfortunately, we didn't have a pullback. Didn't have a pullback after the break of the high. And that's going to happen. Sometimes it will move on without you, but I find you pretty much always want to wait for a pullback towards 50% of a type 3 shift, as you're just going to get a better entry. If it doesn't pull back, you miss the trade, that's completely fine. I miss like around 30% of my trades on average. And so in this example here, we're now at the open of the next hourly candle. And we're just going to wait for it to overextend in a certain direction again, because we're still in a range. We're still going sideways. So we have the hourly candle open, overextend for the first 20 to 30 minutes into that range. We have a clear break to a low into a break to a high. And so in this example here, we have a pretty nice reaction around 30 minutes into the hourly candle. Well, we're approaching the 30-minute hourly candle open. And so I'll just get up my timing here. The ideal sort of setup, what you want to see is, and so for this example, we have a bit of a type 3 shift. If I just drop down onto the 5 seconds chart, we have a clear break to a high after taking out a low. So, when we're waiting for a pullback towards 50% of the previous move, sometimes on the low time frames, it's not going to pull back towards the 50% area. What I tend to do is not take the breakout. I'll just wait. I'll trail this. So when we're taking out high, taking out high, taking out high, I'll trail it to the next high. So this is the next high. This is now the 50% area. And so I'll wait for a reaction at this 50% area to take an entry. So I'll take the entry there. Stop will be below the recent low. And then I'll just target 50% of the range, 50% of the previous move for a pretty nice setup. And so, that's pretty decent reaction at the 50% area into taking out that high. So really, textbook setup as well. This is the hourly candle open here, overextends bearish. And then around the halfway point of the hour, you have it shift and go into correcting the halfway point or reverting back towards that mean. So timing is extremely important with these type of reversals. We have the 30-minute mark here, 30-minute mark here. And yeah, it's extremely consistent. And so that's the stupid, simple 3-step strategy that I use every single day. And hopefully this is helpful. Go test it out yourself, put it into practice, take action on it, because it'll take some time to get used to it. It's like riding a bike. You're going to fall off a couple of times, but you'll learn. And if you have anything you want me to cover in the next video, just comment it down below. And as well, there's the free journal template, free trading dashboard with my trading plan that you can download for free in the link below. So I'll catch you guys in the next video.